Great. Well, welcome everybody. It's so great to see you. I'm so glad that we could get together tonight. It's really a follow-up to Barbara Sanders and Stan Parisi's wonderful seminar on Medicare and estate planning. And they both mentioned the importance of long-term care insurance. So I thought it would be really helpful to have a session just devoted to that. Meredith's presentation lasts about 30 minutes and we'll have question and answer afterwards. And during the Q&A, you can either raise your hand or use the chat box or unmute yourself to ask questions. And, please, I've muted everybody now during the presentation. After the webinar, I'll also send out a copy of all the slides as well as some other materials that Meredith put together that she thinks will be helpful for you. So I'm pleased to introduce you to my wife, Meredith. She's a long-term care insurance planning specialist who has represented the top long-term care providers for over 18 years. She works nationally with clients for all types of long-term care products. In addition to representing traditional long-term care coverage options, she also represents hybrid solutions that include a death benefit. She was voted top 10 women insurance agents by Boston Women's Business Journal. She advises individuals, families, and small businesses on the appropriateness of long-term care coverage. Her goal is to preserve her clients' retirement portfolios, as well as to protect their families from the financial and emotional consequences of requiring long-term care. She's helped many small business owners and self-employed individuals take advantage of the favorable tax treatments available for long-term care benefits. After an extensive career in HR and executive placement, she began specializing in long-term care insurance protection in 2003. She's won numerous industry sales and recognition awards. She's a member of the $1 Million Round Table, the premier association of financial professionals, and has been certified through CLTC, the Corporation for Long-Term Care. She holds a bachelor's degree from Penn State University, as well as an MS degree in Human Resources Management from Golden Gate University in San Francisco. So without further ado, I turn it over to Meredith, and she'll take it away.
Thank you, Larry, and I really appreciate the opportunity to be here this evening. There's going to be a lot of material condensed into this presentation, but you're not going to be tested on this, so you don't have to take a lot of notes. We're going to get you the slides. Okay, so when we talk about long-term care, what is long-term care? What does it mean? The definition of long-term care is when a chronic condition, an injury or an illness limits a person's ability to carry out basic self-care tasks called activities of daily living. The 6 ADLs are bathing, dressing, feeding, toileting, continence, or transferring, such as from a bed to a chair independently. It's what we do every day and we don't even think about it. Most long-term care is custodial in nature, not skilled. The goal of long-term care is not to cure an illness, but to give a person support through an optimal level of functioning. Long-term care includes a variety of medical, social, personal, supportive, and specialized services needed by those who have lost some capacity to self-care because of a chronic illness or a disabling condition. So what does care cost? The average cost for a year in a private nursing home was over $105,000 in 2020. Keep in mind that a national average does not take into consideration state and regional differences. For example, care can cost twice as much in Boston compared to a city in Mississippi. And because the cost of care tends to double every 15 years, what we're looking to protect is not necessarily the cost of care today, as much as the cost of care way into the future. Solutions commonly believed to help pay for long-term care. When you think about how are you going to cover these rising costs, what comes to mind? Many assume that health insurance will cover long-term care costs, when in fact it does not. Medicare is another common misconception. It will cover a portion of skilled care costs, like in a nursing home or a rehab facility, but only up to 100 days. Medicaid is another option, but only for people with assets of $2,000 or less. Self-insuring is an option that many people rely upon. But considering the cost that we saw on the previous slide, it may not be practical for many people knowing what care costs today is going to be a drop in the bucket compared to the time that there is an extended care event. So what is the impact of self-funding? Many people are going to default to that paying out of pocket. People will liquidate their assets faster than they intended. Spending down on managed accounts, annuities, or cash can cause a ripple effect on other planning, such as taxing Social Security or raising Medicare premiums unnecessarily. This may potentially create a retirement lifestyle that is less than desirable, or leave children with a reduced or depleted inheritance. When one spouse needs care, the other spouse is still going to need to maintain his or her lifestyle and financial security. And while having a family member provide care may work for some people, many don't want a spouse or an adult child to become their caregiver. It's much better to oversee the care than to directly provide it. And not all families have members in a position to step up to that caregiving plate. Owning a long-term care policy provides earmarked funds to keep couples financially secure while one spouse receives care. Caregiving can be physically and emotionally taxing. So having funds to pay for care can help preserve the physical and emotional health of loved ones participating in the caregiving. Most importantly, when people plan ahead and let their family members know what the plan is, chances are far more likely that those choices are going to be implemented. So what's the difference between long-term care and long-term disability? There can be some confusion here, and they sound pretty similar, but they actually solve two very different problems. Long-term disability is insurance to help replace income due to an injury or illness. It is not designed to cover long-term care costs. Long-term care insurance isn't designed to replace income, but rather designed to help cover long-term care costs so that income and assets can be preserved. According to the government website, LTC.gov, 70% of Americans are going to need some amount of long-term care services at some point. The older we become, the more likely it is that an extended care need is going to occur. Because we're living so much longer compared to years ago, the likelihood of requiring assistance has grown astronomically. Let's take a minute and just take a look at some of these figures. These numbers are from last year, but each year the numbers climb, both for care recipients and care providers. Since people are living so long, what commonly goes hand in hand with advanced years or a significant cognitive impairment like Alzheimer's or dementia, it's just a natural occurrence for living a life that's a very long life. So looking at some Alzheimer's statistics, there were an estimated 6.2 million Americans age 65 plus with Alzheimer's in 2021. And these numbers are increasing rapidly in coming years due to the baby boomers. By 2050, the numbers are expected to more than double to 12.7 million. They're calling it an Alzheimer's tsunami. New treatments for common ailments like heart attack and blood pressure are being discovered and helping Americans live longer lives. But since there are few treatments and no cure for Alzheimer's, living longer lives can make preparing for retirement difficult. Looking at the average length of an extended care need, how long does it last? Well, there's going to be a wide variation here. But if we just look at the statistical middle, the average length of long-term care claim for men is 2.2 years. For women, it's 3.7 years. And for someone with Alzheimer's, it's 8 years. Let's talk about some of the facts and figures for long-term care. Higher demand. As our population ages, demand for long-term care services increases, and higher demand often leads to higher costs. Longer lifespans. Advances in medical technology are helping us live longer, but as access to new technologies increase, so can the cost to use them increase. Family dynamics. Most parents do not want their children putting their lives on hold to provide their care. And if they did, will the care responsibilities be spread equally among the children? Probably not. The governments. Which of today's programs will be available many years in the future, and who will be eligible? Can we really count on the government to pay for our long-term care needs and allow us to choose and control the setting in which the care is received? When can it happen? When people ask me, when is the ideal time to obtain a long-term care policy, my tongue-in-cheek answer is right before your health changes. But since we don't know when that will be, a policy will never be easier to health qualify for or cheaper compared to when you first look into it. People who wait either may not health qualify or they're going to pay more in the long run. If you pay a lower premium for more years, it tends to be less expensive than paying for a higher premium for fewer years. So there's some special consideration for women. Long-term care can have a large impact on many people's lives, but females in particular seem to be affected the most. And there's a couple of reasons for that. First, many women live longer than men. In fact, on average, women live 5 years longer than men. And in addition, women are twice as likely to outlive their husband. Because of this, many women are on their own when they begin needing long-term care. Research has found that women in their 60s are twice as likely to develop Alzheimer's compared to breast cancer. On top of that, 75% of unpaid caregivers are women, usually the wives and daughters or daughters-in-law. Husbands tend to need care first, and without additional planning, he gets care primarily from his wife and daughters. The wife is then left behind, to get care from her own children. And this can be financially and emotionally taxing for both the adult child providing the care as well as that adult child's spouse. However, long-term care coverage and planning can help alleviate the worry that women or men will not be prepared if they need long-term care. You may not need care, but if you do, how will it affect your family and what will the consequences be? Regarding the impact on a spouse, here are some of those impacts. Emotionally, spousal caregivers can be likely to experience depression at an even higher rate than the care recipient. Caregiving Caregivers may feel as though they're adjusting to taking care of an entirely different person, especially with a diagnosis like dementia, which can leave a caregiver mourning the loss of their previous lives with their husbands or wives. Physically, there's an emotional strain that can have an undeniable impact on someone's physical well-being. Excess stress can lead to poor sleep, increased blood pressure, weight gain or loss, headaches, and other symptoms. Wives may have trouble physically helping their husband move around the home due to a sheer difference in weight and size. And husbands may find it that their own physical condition makes it difficult to help their wife with their mobility. Adding to the emotional and physical impact of an extended care need, the other spouse may now face a disconcerting new reality. Financial concerns about the impact of reduced assets and income can add a whole new level of worry. Regarding the impact on adult children, here are some of the greatest impacts. Depression and perceived burden, especially when caring for a parent with dementia. Over 33% of caregivers report high emotional stress, especially when the adult child feels they have no choice but to provide the care. 1 in 4 caregivers report difficulty taking care of themselves and may actually have made their own health worse. More than 50% of working caregivers suffer impacts to their work due to caregiving. Most caregivers reported having at least one impact or change to their employment situation, including working fewer hours or taking time off to provide care. Some reported taking a leave of absence so they could provide the care. Potential impact on siblings. Siblings might not have a model for how to work together to handle caregiving and the many practical, emotional, and financial issues that go along with it. While some families may be able to work out differences, others may struggle. They say that a parent's long-term care need can tear a family apart rather than bringing family members closer. There can be tension and resentment. Fights often occur over caregiving. Who does? Who doesn't? How much? And who is in charge? The sibling who lives nearby or has a closer relationship with the parent might take on more of the caregiving role. One sibling may become a parent's caregiver simply because he or she doesn't have a job or needs a place to stay. Family members might think that this arrangement might solve a lot of problems, but it can be a recipe for trouble. The family must spell out clearly what that person is expected to do, whether there will be financial compensation, how will that work, and that sibling should be very clear about what support tasks they will provide. So different types of long-term care policies. Let's talk about how to formally address a long-term care need. There are different approaches to developing a plan that addresses long-term care. A traditional long-term care policy is best for people who desire coverage with lower premiums compared to other types of long-term care solutions. These policies do not include a death benefit, but it is possible to include a shared feature between spouses, potentially doubling the amount of benefit for one person. We haven't talked about underwriting yet. Underwriting is when the insurance company decides whether or not to offer a policy to an individual. Underwriting examines detailed medical history, including family history of dementia or Alzheimer's, current treatments, medications, hospitalizations, physicals, etc. And here's a helpful hint. If you're interested in looking into long-term care insurance, do not tell your doctor that you're having memory issues. If that gets written into your medical records, that can definitely be a knockout. Underwriting for traditional policies tend to be the strictest. You need to be in good health to qualify, and with traditional policies, you pay a premium until you need care, at which point The policy reimburses your care up to the monthly benefit amount. The traditional policies can sustain a rate increase over time, and in fact, older long-term care insurance policies have undergone some significant rate increases. However, newer policies have certain features about them that make them less likely to undergo increases similar to those in the past. And some insurance carriers have exited the marketplace for new policies while still honoring their existing policy holders. It is said that traditional long-term care insurance can provide the most bang for your buck. Hybrid policies are attractive to people who like the idea that a company must pay out whether or not there is a long-term care claim. With hybrid policies, the premium can be spread out over a period of time, like 10 years, or paid in a one-time lump sum. Some companies will allow continuous payments, and the premiums cannot increase on a hybrid plan. An additional long-term care benefit is included in a hybrid plan beyond the death benefit. And hybrid policies tend to be more liberal with underwriting. The insurance companies typically will accept people with some more health issues compared to a traditional policy. There are hybrid life and hybrid annuity policies that can be funded from the value of an old life insurance policy or annuity policy that's no longer needed. Sometimes clients will have an old policy with accumulated value that can be converted into a hybrid long-term care policy. This is called a 1035 exchange. The last type of policy is a life insurance policy with a long-term care or a chronic illness rider. This option is best for people who are most concerned with leaving a legacy or financially protecting loved ones when they pass away. But they still want to have access to the death benefit if long-term care needs would arise. These policies tend to have easier underwriting than traditional or hybrid policies. So how do we choose benefits? When we design a traditional long-term care policy, here are the key components. Number one, how much of a benefit for care? And we tend to tie this to a good amount of home care or perhaps to cover assisted living. Most people do not obtain enough of a benefit to fully pay for the worst case scenario, a nursing home. Number two, the next component is how long of a benefit period. However, the selected benefit period will always automatically extend if less benefit was being used compared to what the limit was until the unspent benefit got used up. If we multiply how much benefit times how long of a benefit period, we get a pool of money for long-term care services. Number three, an elimination period is either a waiting period before benefits would begin, or in some instances, it's like a deductible that you pay first, such as with your auto insurance. But it's expressed in a number of days, and 90 days is the most common elimination period. And number four, we include inflation protection, commonly 3% compound, to automatically grow both the monthly benefit as well as the total pool of money. This is to allow policy benefits to keep pace with future costs. So let's look at an initial pool of money checkbook. Continuing the discussion about plan design, here are a couple of examples. In example one, we begin with a monthly benefit of $5,000 if the policyholder needed care tomorrow, and a benefit period of 2 years, resulting in a pool of money in year one of $120,000, which is 5,000 times 24 months. That's the $120,000. But because of the included 3% compound inflation protection, in 20 years, it would have grown to over $9,000 a month and over $216,000. In this example, if in 20 years the policyholder was using less than that $9,000 a month, the benefit would have automatically extended beyond the 2 years until all the benefits in the pool of money are spent. In the second example that's shown, in 20 years, the total benefit would be over $390,000. But let's say the client applied with the spouse and we included a shared rider. The benefit available would be $390,000 times 2, or $780,000. The shared feature answers the question, what if one of us doesn't need care? And what if one of us has a longer illness? In addition, some options will offer an unlimited benefit period. How do I qualify to receive benefits? Regardless of which type of long-term care policy one has, the definition of when it can be used tends to be the same. The trigger is needing assistance with at least 2 out of 6 activities of daily living, with your doctor's expectation that the long-term care need is going to be for at least 90 days. That's the long part of long-term care. Or, not and, but or, there's a significant cognitive impairment like dementia or Alzheimer's. This definition meets the requirements to be tax qualified, meaning the benefit for care would not be taxable. So let's chat about claims. This photo is of Larry's dad. And this past summer, the extended family celebrated his 95th birthday with him. He is living his best life in assisted living, partially paid for by his long-term care insurance policy. Where do people tend to receive care when they own a policy? Over 50% are used for care within the home. The next most likely place it's used is in assisted living. And the least likely place it's used is a nursing home. Because the policyholder always chooses where they use the policy, and there's no other way, most people will tend to use the plan to avoid a nursing home. I once had a client use the policy because he fell off a ladder when he was cleaning out his gutters. His recovery was a long process, and the policy paid for his care during the time that he was needing care. My own father used his policy for the shortest time imaginable. It was 45 days. Although his doctor predicted he would need the help for at least 90 days after he had an accident, he fired his caregiver after day 45 and said, "I can do it myself." Several of my current clients are using their benefits for early onset Alzheimer's and a few of them for strokes. When I first met them years ago, I never could have imagined that this would happen to them, but it did. And that's the rub. Many of us can't imagine ourselves in compromised health. It's the least likely thing to be planned for and the most likely thing to actually occur. So that is the formal part of my presentation, and I will be taking questions. To ask a question, you can click the raise your hand button, but I'd like to ask you a question first. And Larry, I don't know if you're able to remove the spotlight so I can see people. So click view here. All right, here's the question. Would you raise your hand if someone in your own family had a long-term care need, whether that be at home, assisted living, or a nursing home? How many people have lived through that in their own family? So, okay, everybody, most people. And that's usually the impetus to look into long-term care coverage is because people say that was sort of a nightmare and it cost so much money. And I don't want my kids or, my spouse having to be put in that position. That my experience is that people who have lived through that say, I just don't want history to repeat itself. So, okay, Larry, I'm going to leave it to you to start taking.
Yeah, I would say, thank you, Meredith. But I would say, anybody have questions, just unmute yourself and ask.
Larry, first of all, I want to thank Meredith. That was a terrific presentation.
Thank you.
Concise.
Thanks,
Can you give some indications of costs of these policies?
Sure. Of course, there's going to be a wide variation depending upon how much benefit. But if I could just say like a general range for a traditional long-term care policy for a couple in their early to mid 60s, might be anywhere from maybe $4,200 a year to $5,200 a year as sort of an example.
And that would give you what pool of money?
I'd have to play with the quote, but it would give you a decent benefit. So I could talk to you, one-on-one and go to my software and play around with that. But that's sort of a general range.
Okay.
Meredith, I have one of these policies, and every year they say, do you want to increase your premium? Do you want to? And then of course your rate goes up. And if you look out over 20 years, it becomes unbelievable what you're paying 20 years from now in a premium. And then if you turn it down twice, then they say you can't bump up your premium ever more. What do you advise? Do you say keep ramping up the policy, or do you advise stopping at some point?
So what you're describing is a group long-term care insurance plan with something called future purchase option. The group long-term care policies, rather than including the built-in inflation protection, would offer it to the policyholder every couple of years. And either you accept it and your benefits grow and your premium grow, or you don't accept it and then your premium and benefit remain level. So for people who purchased a group policy and they only have the option of purchasing inflation protection every couple of years, my advice would be, as long as the premium is still comfortable, to accept the increase. But at a certain point, when that's not the case, then clearly you're not going to be able to continue to do that. But as I mentioned, the modern plans that are not group plans include the inflation protection, and that will not increase your premium every year when your benefit grows every year.
Thank you.
Meredith, question for you. I've often heard the argument, and I don't have a policy at this, but we don't have a policy, that one could self-fund this by investing the same amounts of money and probably make whatever you would have paid in premiums to have the policy. How do you talk about that argument with people?
Sure. There's a couple different points that come to mind. First is, with the long-term care insurance, you're leveraging your dollars. It's not a dollar for dollar correlation. So if I'm spending $1 in premium, I might be getting, for example, $10 in a long-term care benefit. The other issue is, we don't know if there's going to be a market downturn, if God forbid you have a stroke, and now you have to quickly sell your assets when the market is down and have some potential negative consequences to your retirement portfolio. You're going to have to pay capital gains tax at that time, and you might be pushing up your income, which is going to impact Social Security and Medicare. So those are just a couple of the issues of self-insuring a long-term care risk. It's that dollar for dollar paying out of pocket versus leveraging a premium dollar and maybe having to pay capital gains tax, maybe having to sell when the market is down. So those are just a couple of issues.
Hey, Meredith.
Yeah.
This is Stan Parisi. How do you advise people relative to the could turn into very long-term strength of the insurer facing the tsunami of baby boomers who are to come along, namely 2008 sort of taught us all that there is nobody too big, including AIG, that can't get sucked under if things go really, really bad. So how do you advise clients in terms of managing the risk of the financial stability of the insurer?
So I look for a couple different things. One is ideally that insurance company is going to have other products besides long-term care insurance. So the risk is spread within the company amongst other divisions. I do want to see a top A-rated company. I do like a mutual company, so the company doesn't have to necessarily answer to stockholders as much as to their employees. I want to see a company very well capitalized. So yeah, of course, there were a couple of companies, AIG is one as an example, that had some financial issues. And I will also counter that by saying no one with a policy was left high and dry.
Right.
There's something called a state guarantee fund, which would take over if an insurance company did become insolvent. So a policyholder would not be left, high and dry.
So, and I guess the follow-up is it a red flag if a premium appears to be too good to be true?
Nowadays, I'm not seeing too many too good to be true premiums. When I started in 2003, the premiums were quite inexpensive then compared to now, but I'm just not seeing cheap, premiums now.
Got it. Thank you.
Meredith, I just want to know what your thoughts are about the policies that AARP is promoting. I know that I received some correspondence from them in the mail, and this is a kind of new area for me, and I just want to know what are your thoughts about it, or what's been,
Okay.
are you familiar with them, and what information you'd like to
Yeah.
share?
So AARP is truly a marketing organization, and they do not underwrite long-term care insurance policies or life insurance policies, but they partner up with other companies who do, and then they get funneled a piece of the premium back if the person purchases through them. So I would say the most important thing is evaluating the policy itself, not who's promoting it necessarily, like in AARP. So I have quoting software from all different companies, so I can do side-by-side comparisons of different companies and different plans. And I think that's much more important than, I watched the TV commercial and so recommended this. I'd say, well, let's drill down into what are the premium and benefits and features. What else?
Meredith, this is maybe an ignorant question, but say you bought one, and I'm just making this up for, a 2-year span. If you have an event that seems to qualify and you begin to use it, and then that event actually kind of resolves and you don't need long-term care, is that amount of time you used it for then just taken off the full amount of time you've bought a policy for? Or does it?
That's a great question. So it's not so much the amount of time as it is the dollar amount. So let's say I had a $400,000 long-term care benefit and I used up 100,000 of it, but then I got better. Now there's 300,000 left in my pool of money for the future, and it continues to grow with the inflation protection. So that's how that works.
Great, thank you.
And just wondering about Meredith, this is great, by the way. Thank you so much for doing this presentation. It's also wonderful to see so many of my classmates and other spouses and folks. And it's just a good experience. This is not something that we've thought about that much, and that's partly why we're on the call now. When we think about timing for consideration, obviously the older we get and the more compromised we get, the more expensive it would be. But typically the age range for the types of clients that you're seeing would be sort of mid 60s, late 60s.
No, I would say late 50s to 65.
Okay. So that at that point after 65, it gets to be too exorbitant, or?
People tend to be declined more. As we get older, we have more health conditions and the underwriting gets stricter. So as people get to be in their late 60s and they have more health issues, the decline rate tends to be much higher.
So you can't get it then?
You can't get it if you've got a whole bunch of health conditions. Although there are some hybrid long-term care annuities that I've gotten people who have gotten crazy amount of health conditions approved. So some products will be more flexible, like a long-term care annuity is easier to qualify for compared to a traditional product.
And just to follow up on Marcia's question, so you've got your 300,000 left because you spent the 100,000, then you got better. Is that just sitting there? If you didn't add the inflation thing, you can't invest it, obviously. I'm a little bit clueless about how you mentioned before when Marcia asked the question about why not just self-fund, and you said that you had a couple of good ideas about what might happen if you had to sell when the market was low or something like that. But I'm just curious, it will only be at the rate of inflation if you, and otherwise it just stays at the 300,000?
Well, I almost always encourage people to get inflation protection with benefit.
I hear you.
So it's going to be growing by, for example, 3% compound a year. Whatever is gone from the pool of money because you used it is gone, but whatever's left is going to continue to grow with that inflation protection until you're ready to start tapping into it again. Does that make sense?
Meredith, question for you. If let's say you've got a policy and you've only paid 1 year of premium, and then you become incapacitated and you need it, you haven't really put anything in.
Yep.
How do you calculate your pool of money?
In that case, the insurance company would have lost, even though you didn't have time to let it grow with the 3%
Right.
compounding. You have your whole initial pool of money to use immediately.
Because you've set up and said, I'm going to put this in for, how do they calculate what that pool of money is?
It's the how much times the how long equals the pool of money.
That you signed up for.
That's the level of benefit that I applied for and got approved for. That's what my contract says my starting benefit is.
Okay. All right. So in that case, they would lose, just as if you bought a life insurance policy and you died early. Then
Exactly. Right.
Okay. So it's not like you have to fund it. It's not like a college tuition thing. You have to fund it for it to grow.
No, that's their risk. You could use it immediately. My client who used it because of his ladder incident, he had gotten the policy from me just a couple of years previously.
And question about, the premium goes up as you get older. If you're in really good health, is there an inflection point where, let's say if you look at your family tree and, everybody's lived to 100 and, you have no long-term, you have no chronic medical conditions. Is there a point where you say, well, I should wait till a certain age because you're playing that game, you're looking at the calculator and you're saying you're going to spend, it's almost like self-insuring. And then at some point you're going to say, I'm not going to self-insure anymore.
So 2 thoughts about that. The first is, if you have longevity and people in your family tend to live a really long time, what goes hand in hand with that is needing long-term care. People who have a family where everybody dies early of heart attacks, those people might not be as concerned about long-term care, if they have that sort of family history. But longevity typically equals care. And remember, I said it's never cheaper compared to when you first look into it. If you do an Excel spreadsheet, it's always cheaper to pay a lower premium many more years than a much higher premium for fewer years. So no, I wouldn't recommend waiting if you think that it makes sense to look into it.
All right.
Meredith, I'll just comment that my father has a very generous long-term care policy, and I, at age 64, I'm blessed with a very healthy dad in his mid-80s and a not so healthy mom who has dementia. He's been able to have home care for her now for several years, and keep her home, and she's happily confused. And, he has a life because he has somebody that can care for them and doesn't have to depend on the family to do it. And it's brought a lot of peace to us as well as to him. And I think, guys, we're all 64 this year. It's kind of now or never for no pressure, Meredith, you're going to get 25 emails tomorrow. Hey, what do I do? But, I've been looking at it. I have a financial planner who's dead set against it. And I am struggling with it, and I probably will reach out, but we should all consider it very seriously. Because
can I ask you why your financial planner? Let's hear why he or she is dead set against it.
Never use it. It's insurance. You may never use it, and I just think that some people, and you have assets that you could liquidate. So, do I ever think we will lose everything if I don't get it? Hopefully not. But I worry more about losing my mind than my body. You guys all know I run, ski, golf, whatever, and I'm still working and plan to keep working. So I worry far more about my mind because of what's going on with my mother than my body. And what Meredith said about not wanting to be a burden to your children that's something I worry about. Having said that, we just lost my mother-in-law at 94. She was home till 6 days before she died. So,
Yeah.
The crystal ball, it's a crystal ball, and it's a piece of mind, and it's what you consider a risk, really. So, sorry.
No, I think that was really helpful. And to like a financial planner who says, well, gee, what if you never need this? I'd say, well, what if you do? But they call a hybrid policy a smarter way to self-insure, because if you take just a little piece of your retirement savings or your investable income and you put it into a hybrid policy, if you don't end up needing long-term care, then that premium goes back to your beneficiaries tax-free. It's like you would have had the policy all those years for free. But if you do need long-term care, you're going to get like maybe 3 or 4 times what you put into it as a long-term care benefit. So that's what I would say to the financial planner who says, what if you don't need it?
Yeah, I don't tell them everything either. So
It may also be the idea that we were exploring earlier around when you invest, what you get out of it and what the other benefits. My husband is taking our obstreperous dog out right now. But he had a question about the tax benefits to doing long-term care and wondered if you could touch on that. So I'll take the notes, and he's got the dog.
Yeah. So the benefits are always tax-free, but in terms of deducting the premium, if you either have an HSA or you are even partially self-employed and you file a Schedule C of some self-employment income, then you are able to deduct the premium up to this chart that I have of age-based limits. So the short answer is if you've got the HSA or if you file a Schedule C of self-employment income, then you have this nice deductibility of the premium.
So I'm not self-employed, but my husband is. So he could, for his benefit.
Not just his, but yours too, because you're the spouse of a self-employed person.
I got it. Okay, right. So regardless of the fact that I'm not self-employed and the primary person cranking out the money, then it would still work for him to do it that way. And then the other part that's interesting in answer to, part in answer to Kathy's point, where you go with a hybrid policy, you could either use it for long-term care or it could be a life insurance policy. At least that's my understanding of it. So it would add to any life insurance benefits you have if you ended up not using it And our family has a lot of longevity as well. Like my mother-in-law passed, my mom passed at 92, my great aunt at almost 100. And thank goodness they were lucid. Who knows if I will be though, you just don't know.
Sure you will, Melinda.
Yeah, I think it would, I'm certainly gonna do my best.
Meredith, a quick question for you. Is there any scenario where any of your clients have been able to leverage their whole life insurance policies? I mean, I remember buying these policies back in the day that we were going to use it to pay for college tuition. We never used it for that purpose, but we're still paying for them. They're not insubstantial. Are there ways to leverage our life insurance policies?
So people who have an old life insurance policy that they purchased years ago, and when you got that policy, your goals were very different than they are today. Your goals were funding college education, and what if you died, you had a mortgage, and all that sort of goes away at a certain point. So you've got these old policies, but they've built up some significant cash value throughout the years. Assuming that someone is health qualified for a hybrid long-term care policy, they can do something called a 1035 exchange. That's a section of the tax code where once you're approved for a hybrid policy, you can use the cash value in the old policy and exchange it to the new company. So there's no tax consequence to you, and it would fund the new policy. So yeah, that's something that's very attractive to people who have these old life insurance policies.
Yeah, it's really old. Like it was sold to us right after we got married.
Yeah.
1986.
Worth checking out.
Okay, thank you.
Well, you've got some longevity, Dana. I saw 90 years your dad just turned.
Yeah, my dad just celebrated his 90th birthday is today. And my mother's was her 89th was last week.
Wow.
And both have minds like steel traps. So I'm hoping to inherit those good genes.
Congratulations to them and to you that you have them. Awesome.
So I have a couple of other questions that Meredith and I had put together. If nobody else has any other questions, I think there's some important other issues. Do you want to mention a partnership policy, Mayor?
So depending upon what state people live in, there is something called either partnership for long-term care, or in Massachusetts, we have something different, which I can explain in a moment. But many states, most states have a partnership for long-term care. And essentially what that means is because Medicaid is going broke, the states got together and they said, what can we do to incent people to get long-term care insurance and not rely upon Medicaid, which is going broke? And what they came up with is this partnership for long-term care. So if you have a partnership policy and you live in one of these partnership states, whatever dollar amount of long-term care benefit you had used, let's call it 300,000 as an example, that's the amount of benefit from your policy that you used, then you can shield that amount from your personal assets from being spent down on Medicaid. So in that example, you use 300,000 of a long-term care benefit. Sorry, your care needs are going on and on. You use your personal assets. You did end up on Medicaid. Then the state would shield 300,000 of your personal assets from Medicaid. In Massachusetts, we have a law called the Masshealth Lean Law, LIEN. And that says, if you used up your long-term care policy benefits for home care, if you have at least a day left of the policy, as of the date you did enter a nursing home on Medicaid, the state would shield your primary residence from being attached by a lien from Medicaid. It protects the value of your home, which in Massachusetts tends to be our most important asset. So you can leave it to your beneficiaries. But if you don't have long-term care insurance, the state would attach a lien on your home and they collect back once the house is sold to sort of recoup what they spent for your care on Medicaid. So that's a little bit about that.
Isn't there like a homestead clause or something? I'm so clueless about this.
Yeah.
that would
The
protect you from that.
Homestead Act can be pierced by Medicaid. So people used to think, oh, I have my house protected under the Homestead Act. Not anymore.
So the only way that you could protect the house, then it sounds like, would be to do this kind of partnership for long-term care that you refer to.
Or, have it protected by the Masshealth Lean Law, or have given your home to like your kids at least 5 years previous. The look back period for Medicaid now is 5 years. It used to be 3 years. They're talking about making it 7 or 10 years. You would have to have gotten the house out of your name.
But Mass is a communal state. So even if they were to put my mother in a nursing home and her name's been off of everything for years, because because they're married, they still look at my father's assets. We found out the hard way very recently. So my understanding, Meredith, and maybe I'm understanding it wrong because this is really complicated, but that's what we were told when we met with the nursing home.
Yeah, the state does consider married couples' assets joint. And it's sad. I've heard of elderly couples getting a divorce for that reason. Really sad to think.
I have a friend who did that. And then when the obituary, they showed that they were divorced and people are like, what?
Yeah, right.
But at least he was able to get his care and she didn't, lose everything.
Mhm.
Mayor, what about using policies in different states? Like you buy the policy in one state and you move to another, you retire to another.
Totally portable in any state. And you might get more bang for your buck in a cheaper, warmer state because care costs less, but you can purchase a plan in one state and use it in another. It doesn't matter if you move.
How about, can the insurance company change the terms of the policy once we obtain a policy?
No, because you have a legal contract. For new people, if they change the policy for new people, that can happen. But no, if you have a policy, they cannot change the terms of your contract.
How about if there's a family history of Alzheimer's, can someone still get traditional long-term care insurance?
Yes, as long as it's not both parents. So now they're saying if one applicant has both parents diagnosed with Alzheimer's or dementia, please don't apply. The hybrid companies don't say that, but the traditional policies do.
And is there an age requirement as to when a long-term care insurance policy benefit can be used?
No. If you have a policy, God forbid you're hit by a bus the next day, you could use the policy right away.
And one last question, if I'm declined for the insurance, could I still become approved in the future?
It depends. It depends on the reason for the decline. It depends, was it a traditional company and now you're applying to a hybrid policy? That could be. But if you were declined for a health issue, many traditional long-term care companies say then don't apply to us because they're assuming that there is some significant health issue that's continuing.
Hey, Meredith, for health histories, quick question that just came up. Do you, I assume they will ask for your parents, but will they ask for health conditions of your grandparents as well?
No, for grandparents, and for parents, they only ask dementia or Alzheimer's or like ALS, or there's one other really terrible health condition that they ask about, but no for grandparents. Mm-mm.
I think my grandmother died of dementia. That's why I asked.
What about siblings, or just only parents, really, I'm assuming?
Siblings, only if it's Alzheimer's or dementia.
Okay.
That they really care about because the claims are just going crazy for that.
Meredith, do insurance companies inquire about gym memberships?
No.
Okay.
Do they care if you participate in triathlon sprints?
No, but they look at your medical records. What has your doctor written down about you? That's what they really care about.
If you're a cancer survivor, is that going to be an issue also, or is it really more the dementia thing they're freaked out about?
No, if you're a cancer survivor, they just want to know that enough time has passed. It was caught early, it was treated, clean bills of health since then, that kind of thing.
Meredith, they should really want me. My parents, my mother died at 36. My father was gone at 61. I'm a great candidate for them, right?
Well, it
Michelle.
depends upon your own health history.
Oh,
you know.
okay. So
Yeah.
it won't have a major factor. Okay. Won't be a major factor.
I'm so sorry you lost them so early, honey.
I know it was different. It was very different.
Yeah,
As you grow, you get resilient from that.
yeah, yeah.
Meredith, a quick question. Has COVID and the emergence of long COVID entered into the conversation?
Yeah, if someone has had COVID, if they were hospitalized, there's like a year wait to be able to apply. If they weren't hospitalized, there's like a 3-month wait after to apply. And if they have long haul symptoms, then they are uninsurable.
So would you be better off? I mean, I've had COVID, but I don't have long haul, but my wife has a little bit of long haul. Would you be better off not seeking medical attention for that since they can't do anything for it anyway?
So the short answer is if a person hasn't yet come to their doctor saying, I'm having continuing symptoms, from COVID, for example, then that's not in their medical records.
Right.
So that makes it a lot easier than if they've been complaining to their doctor of the long haul symptoms.
Right.
Hey, Meredith, how many, I guess, forms of contracts, how many products, variations on the products are out there? Like how broad is the spectrum of decisions for the consumer? And I'll put it one far end, like if one lives in Massachusetts, state of Massachusetts regulates the terms of an automobile policy. So everybody in Massachusetts has the same automobile policy. It's just a question of how much coverage you want to buy, and then what the premium implications are of that decision. But the basic policy, the language of the policy is the same for everybody. How idiosyncratic are the various products that are out there for long-term care?
You'll definitely see nuances of differences between policies. Within traditional policies compared to traditional, you'll see vast differences. From hybrid policy to hybrid policy, you will see some differences. And life insurance policies with a long-term care or chronic illness rider, you're going to see differences between them as well. So I try to sift down what are those differences between the policies.
Thanks.
Great. Anybody have any more questions? I mean, it's been a wonderful discussion, very engaging, and I think I hope it's been helpful as well. I have a list of everybody who signed up for the seminar, so I'll send out. Actually, Joe, I'll probably talk to you about how to send them out, but I'll send out a copy of the slides, and then Meredith has a few different materials that you might find helpful and interesting. There's some government materials, there's some websites, there's a lot of information out there to learn more about this. So
Another quick question, Larry, in terms
Sure.
of getting access to the recording, because I have some family members and other friends who could benefit from hearing it. Can we get access to the recording on the cloud or wherever you guys would make it available?
I think the answer is yes. I don't know exactly how to do that, but I'll talk to the alumni office because we're using their service here to record it. And I think once it's over, they give a link to that.
Yeah,
and it's probably hosted some.
You'll have the link, and then you can kind of share that link.
Great.
I just want to say how wonderful it was to see you all, and it was great to have this information. And it's a wild time right now. Don't know what anyone's dealing with their families or whatever else, but holding you all in love and light and care. And it's kind of wild to see people's faces across many decades sometimes. And just thank you so much, Larry and Meredith, for your support here. And it's great to have your contact info. Where are you in Boston? You're in
In
Boston.
Newton.
Okay. Yeah, we're
But
in
it's-
Bedford on the Lexington line. So it'd be cool to see you.
And
Well-
you guys, for all who participate, if you have other topics, this has been great. If you have other topics that you'd like us to kind of do another class of 79, conference like this, shoot them off to myself or Kristen or Trisha, and we can, find people to talk.
Yes, great. Thank you, Joe. Actually, I'd heard from Jaya that the other two talks were wonderful. And so I thought, I better go to this one.
Our class
this
has done
is
a
great.
really great job of these talks. I've done a number of them, and our class really has done a great job.
Yeah, it's awesome. Yeah, I emailed a bunch of people and some of them showed up. So that's cool. But thank you again, and lots of love to everyone. Take care.
Great to see everybody.
Thank
Thanks,
you.
again,
Thanks.
Larry. Thank you,
Okay.
Meredith.
Everybody, bye-bye.
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 Good night.
Lots of love. Bye-bye.
Bye.
There's the heart.